Leaving Australia doesn't automatically mean you've left the Australian tax system, and if you don't know that already, you're walking into one of the most expensive blind spots in expat life. You might be sipping coffee in Lisbon, working remotely from Chiang Mai, or building a startup in Berlin, but if the Australian Taxation Office still considers you a tax resident, every dollar you earn, whether it's from a side hustle, a foreign salary, crypto gains, or rental income, is subject to Australian tax. And trust me, you don't want to find that out 2 years later when the ATO sends you a multi-page assessment notice demanding tens, sometimes hundreds, of thousands of dollars in back taxes, penalties, and compounding interest. This isn't scaremongering. It's happened to doctors, digital nomads, entrepreneurs, and even retirees who thought they'd done everything right. The rules are complex, the ATO doesn't send reminders, and in 2025, they're more aggressive, better funded, and laser-focused on people just like you. So if you're planning to leave Australia, or you've already left but haven't formally and legally exited the tax system, this is the most important guide you'll watch this year. Because exiting the Australian tax system isn't about geography. It's not about buying a one-way ticket or forwarding your mail overseas. It's a legal, financial, and administrative process, and if you skip a step, misinterpret a rule, or assume you're safe because you're no longer physically here, you're setting yourself up for a world of financial pain. Let's start with the foundation, understanding what actually determines your tax residency. Forget immigration status. Forget your passport. Forget how long you've been gone. The ATO doesn't care about any of that. They operate under 4 specific tests, and if you meet even one of them, you're still considered a tax resident. The first is the resides test. Sounds simple, right? If you live in Australia, you're a resident. But resides isn't just about physical presence, it's about where your life is centered. Do you still own a home here? Are your kids in Australian schools? Is your partner working here? Even if you're overseas 10 months of the year, if your home base is still here, the ATO can, and will, argue you still reside in Australia. Then there's the domicile test. This one trips up so many people. Your domicile is your permanent home, the place you intend to return to, even if you're living elsewhere temporarily. If you were born in Australia, grew up here, own property here, and haven't clearly established a permanent home overseas, your domicile is still Australia. And unless you can prove you've established a permanent place of abode abroad, with leases, local registrations, community ties, and intent to stay, you're still a tax resident. I've seen people live in Thailand for 3 years, but because they kept their Sydney apartment just in case, renewed their Australian driver's license, and told family they'd come back eventually, the ATO ruled they never left. The third test is the 183-day test. If you spend more than half the financial year, 183 days or more, physically in Australia, you're automatically considered a resident. But here's the catch. Even if you're under 183 days, if you can't prove your usual place of abode is overseas, they can still classify you as a resident. That means if you're bouncing between countries, digital nomad style, without establishing clear residency anywhere, Australia might still claim you. And finally, the superannuation test. This one's sneaky. If you or your spouse are employed by the Australian government, or contributing to certain government super funds like CSS, PSS, or military schemes, you're automatically a tax resident. No exceptions. Even if you're posted overseas on assignment, even if you've sold your house and moved your family, if you're tied to those funds, you're still in the system. Fail to break free from any of these, and you remain a tax resident, which means the ATO wants a piece of every dollar you earn, anywhere in the world. Salary in Singapore? Taxable. Dividends from a US stock portfolio? Taxable. Crypto gains from trading on Binance? Taxable. Rental income from a property in Spain? Taxable. And because Australia taxes global income, you can't just ignore it and hope it goes away. The ATO shares data with over 100 countries through the Common Reporting Standard. Your foreign bank, your overseas employer, your crypto exchange, they're all potentially reporting your activity back to Canberra. Now, here's the next layer, and it's one most people don't see coming. Even if you successfully become a non-resident, you might trigger what's called the exit tax. This isn't a departure fee. It's a capital gains tax event on assets you still hold when you cease residency. Think shares in ASX-listed companies, units in managed funds, cryptocurrency holdings, even intellectual property like patents or trademarks, anything that isn't classified as taxable Australian property, which generally means real estate located in Australia. The ATO will calculate the unrealized gain, the increase in value from when you acquired the asset to the day you officially became a non-resident, and tax you on it as if you sold it that day. You can choose to defer this tax, and many people do, thinking they're getting a free pass. But here's the trap. If you defer, you're locking yourself into future tax liabilities as a non-resident. That means higher tax rates, because non-residents don't get the tax-free threshold. It means you lose the 50% capital gains tax discount that Australian residents enjoy. And it means that when you eventually sell, even if 90% of the gain happened while you were living overseas, you'll be taxed on the entire gain, from day one. So deferring might feel like breathing room, but it's often a ticking time bomb. So how do you exit cleanly? How do you make sure that when you board that plane, you're truly leaving the Australian tax system behind, not just physically, but legally and financially? It's not random. It's not luck. It's a 4-step process, and the order matters. Step 1. Cut your Australian ties, decisively, completely, and with documentation. Start with your home. If you own your primary residence, sell it. If you're not ready to sell, lease it out on a long-term, arm's-length agreement, not to a friend or family member for a token rent. Keep it empty, and the ATO will argue it's still your home base. Close bank accounts you don't need, especially everyday transaction accounts. Keep one open if you need it for final bills or asset sales, but move the bulk of your funds offshore. Cancel your Medicare, don't just let it lapse. Cancel gym memberships, streaming services, magazine subscriptions, anything that auto-renews and ties you to an Australian address. Notify your super fund of your change in residency status. And crucially, notify the ATO. File a change of residency notification. Lodge your final Australian tax return, and if you're eligible, do it early. Some people can lodge a return before June 30th if they've left mid-year and won't be returning. That locks in your non-resident status faster and stops the clock on global income. Step 2. Move your immediate family. This is non-negotiable. If your spouse or children remain in Australia, even if it's just for school or just for another year, the ATO will use that as evidence your life is still centered here. I've seen cases where a husband moved to Dubai for work, but because his wife and kids stayed in Melbourne, the ATO refused to accept his non-resident status, and taxed his entire overseas income. Relocating your family isn't just logistical, it's legal proof your center of vital interests has shifted. Enroll your kids in overseas schools. Move your partner's job. Transfer medical records. Change your family's registered address. Make it undeniable that your household has relocated. Step 3. Establish residency overseas, and I don't mean just showing up. You need to build a paper trail that proves your life is now rooted somewhere else. Sign a 12-month, or longer, lease, or better yet, buy property. Open local bank accounts, not just a tourist account, but proper checking and savings accounts in your name. Set up utilities, electricity, water, internet, under your name and local address. Register with local authorities, get a tax file number, a social security number, a residency permit. Enroll in local healthcare. Join a gym. Get a library card. File a tax return in your new country. Even if you owe nothing, filing proves you're participating in that country's system. And if your new country issues certificates of tax residency, get one. That document is gold when dealing with the ATO. Step 4. Structure your finances properly. If you're running a business, holding investments, or generating passive income, you need to set up offshore structures that comply with Australian rules, not just local ones. That means understanding the Controlled Foreign Company, CFC, rules. If you control a company overseas, and it's not structured correctly, the ATO can still tax its income as if it's yours. It means passing the Central Management and Control Test. Where are the real decisions being made? If you're running your Singapore company from your laptop in Byron Bay, guess what? The ATO will argue it's still an Australian entity. Hold board meetings overseas. Keep minutes. Document decisions. Use local directors if required. Keep your governance clean, your paperwork pristine, and your operations genuinely offshore. And if you think you can skip all this and just wing it, think again. The consequences of failing to exit properly aren't theoretical. They are brutal. Back taxes on global income, going back up to 4 years, sometimes more if the ATO suspects evasion. Penalties that can add 50%, 75%, even 100% to your bill. Interest that compounds daily. Legal fees if you end up in dispute. And the loss of valuable tax offsets, like the tax-free threshold, low-income tax offsets, or franking credits, that residents take for granted. In 2025, the ATO received nearly $1 billion in new funding specifically to target non-compliance among expats, foreign investors, and high-net-worth individuals. They've hired hundreds of new auditors. They've upgraded their data matching systems. They are cross-referencing airline records, bank transfers, property registries, and social media posts. They are not guessing. They are hunting. And while you're planning your exit, don't forget the new property rules. From April 2025, foreign nationals, including temporary residents, are banned from purchasing existing residential property in Australia for 2 years. That's a massive shift for anyone planning to return or invest from abroad. And capital gains tax? It's getting tighter. More asset classes are being pulled into the CGT net, including certain digital assets and collectibles that previously flew under the radar. The principal asset test, which determines whether a company or trust is subject to CGT on disposal, now uses a 365-day window instead of a point-in-time test, making it harder to avoid tax through timing. And if you're disposing of large assets, we're talking over $5 million, you now need to notify the ATO in advance. No more silent exits. Here's the truth. Living overseas doesn't mean you've left the Australian tax system. You have to plan it, document it, execute it, in the right sequence, with the right evidence, at the right time. Don't assume your accountant knows the expat rules, most don't. Don't rely on Facebook groups or Reddit threads. The advice there is often outdated or dangerously wrong. Don't wait until tax time next year to figure it out. By then, it's too late. The moment you decide to leave Australia for the long term, your tax exit plan should be priority number 1, right up there with your visa, your job, and your housing. Because if you don't do it right, the Australian tax system won't forget you. It won't forgive you. And it won't wait for you to come back. It will follow you, silently, patiently, relentlessly, until the bill comes due. And when it does, you won't just owe money. You'll owe years of stress, sleepless nights, and the crushing weight of knowing you could have avoided it all, if only you'd taken the time to exit the right way.